Welcome back to the deep dive. Today we are staring into, well, into the abyss. But it's a strange kind of abyss.
Yeah, it is. It's an abyss that, if you squint, might actually be full.
Exactly, full of plenty.
Yeah.
We're tackling a subject today that, it really feels like it was ripped straight out of a science fiction novel.
Oh, absolutely. We're talking about robots, infinite wealth, the end of work as we know it.
But our sources today, the material we've been poring over, they insist, and they are aggressively insistent, that this isn't fiction. This is economic inevitability.
It is. And it's not set in some far-off future, the year 3000 or something. We are looking at a timeline that is uncomfortably close.
Uncomfortably is the right word.
We're talking 5 to 10 years.
Which is terrifyingly soon. So here's the hook, the question that really sets the stage for everything we're going to talk about today. What happens to the global economy, to your wallet, to your retirement fund, and, I don't know, to the price of a cup of coffee, when the value of human labor drops to absolute zero?
That is the central question. And it's one that, frankly, most economists are too afraid to even ask.
Why?
Because the answer breaks all the models we currently use. It just shatters them.
And just to be clear for everyone listening, we aren't talking about unemployment rising a few percentage points or, a typical recession.
No, this is different.
We are talking about the mathematical value of labor hitting the floor, hitting zero.
Our source material for this deep dive is a fascinating, and I have to say, a very dense analysis of the future economy. It's focused specifically on the intersection of robotics, artificial intelligence, and, crucially, investment strategy.
Right. So the mission for today is to unpack a very specific prediction, a massive shift toward what the source calls an age of abundance.
We have these documents that outline how a specific technology, and they name it Tesla's Optimus robot, is going to fundamentally break the economic equations we've been using for centuries.
And perhaps most importantly for you listening, how a very specific investment strategy is framed as the key to surviving this transition.
Or even thriving in it.
Right. I have to say, when I first read through this stack of material, I got a little bit of vertigo.
I can imagine.
It talks about hyperdeflation and universal high income, which, on the surface sounds great. But then it talks about the total collapse of the labor market as we know it.
The other side of the coin.
Yeah. It's exciting, but it's also heavy, especially if you spent 40, maybe 50 years building a career or saving for a traditional retirement. The rules are all being rewritten.
It is heavy, I agree. But I think the best way to deal with that vertigo is to strip away the emotion for a minute and just look at the math.
Okay.
The source provides a very specific, very simple economic formula. And if we ground ourselves in that, all the wild sci-fi stuff starts to look a lot less like a fantasy and, well, more like a logical roadmap.
All right, let's do that. Let's pull the car over and look under the hood of this economic claim. Section 1, the new economic equation. The source lays out a formula that is, on the surface, incredibly simple. It's economy equals capital times labor. You might see it written as E equals C times L.
Right. It looks like something you'd see in a high school algebra class.
Exactly. But they're arguing this isn't just a simple equation. This is the operating system for civilization.
It is. And to understand why a robot like Optimus changes everything, you really have to understand how frustrating, how limiting that equation has been for the last, 3,000 years of human history.
Frustrating how? What do you mean by that?
Because labor, that L in the equation, has always, and I mean always, been the bottleneck.
The limiting factor.
Always. Think about it. If you're a pharaoh in ancient Egypt and you want to build a pyramid, you have capital. You have the stone quarries, the land, the gold, the food surplus. You have C.
Okay.
But you are strictly limited by how many humans you can physically feed, house, and organize to move those massive stones. The economy can only grow as fast as your population grows or as fast as you can force them to work. L is your ceiling.
Right, that makes sense. But okay, let's fast forward a few thousand years. The Industrial Revolution hits. We invent steam engines, electricity, and now computers. Didn't that solve the labor bottleneck?
This is a really common misconception, and it's a point the source spends a good amount of time clarifying.
Okay.
The Industrial Revolution didn't replace labor. It multiplied labor. It made each unit of labor more powerful.
So a guy with a tractor can do the work of 50 guys with shovels.
Exactly. That's a massive multiplier. The tractor is a huge boost to the C side of the equation, but, and this is the key, you still need the guy on the tractor.
The tractor is the capital. The guy is the labor.
Precisely. The equation became E equals C times L, but the capital got much, much bigger and more efficient. So the L, the labor, became incredibly productive.
But it's still there.
It's still the essential ingredient. This is the insight you have to lock in to understand the rest of this. You cannot run the tractor without the farmer. You cannot write the software code without the developer. You cannot truck the goods across the country without the driver.
So every single unit of economic growth, no matter how advanced, still required a unit of human attention, even if that attention was leveraged 1,000 times over by a machine.
Correct. And because human attention is scarce, we need to sleep, we get sick, we need years of training, we need wages to buy food and pay rent, the cost of everything has a floor.
A floor set by the cost of that human.
Yes, the cost of keeping that L functional.
And this source we're looking at is saying, we're about to just delete the L from the equation entirely.
That's the argument. They are arguing that for the first time in human history, we are on the verge of decoupling production from humanity itself.
Decoupling production from humanity, that's a heavy phrase.
It is. But think it through. If you have a humanoid robot, let's just call it Optimus for this conversation, that can drive the tractor and then get off the tractor and repair the tractor and then go to the factory and help build another tractor.
Then the human is no longer the multiplier. The human is.
Economically speaking, the human is bypassed.
That's a very polite way of saying obsolete.
In that specific economic function, yes.
Okay, but let's play devil's advocate here for a second, because we all heard this story before. The robots are taking our jobs. We've been hearing that since the 1950s.
Of course.
I mean, we saw the robotic arms in car factories in the 80s. I've seen the videos. But guess what? People still work at Ford. People still work at GM. Why is this specific prediction different? Why is this the moment the L actually goes to zero?
That is the right question to ask, and the answer comes down to the difference between special purpose and general purpose.
Explain that.
Those big, orange robotic arms you see welding cars in a factory, they're the definition of special purpose. They are incredibly, incredibly dumb.
Dumb how? They look pretty advanced.
They're programmed to weld one specific spot in three-dimensional space over and over again. If the car chassis coming down the line is 3 inches to the left of where it should be, that robot will happily weld the empty air. It'll just keep welding nothing until a human comes along, hits the big red button, and turns it off.
So it requires a human to set it up, a human to program it, and a human to fix it when it drifts or when something changes.
Exactly. The L is still there. It just moved from the assembly line to a supervision role in a control room. The labor is still essential.
Okay. So what's different now?
The source material focuses heavily on the end-to-end neural network capabilities of this new generation of bots. This is the game changer.
That sounds complicated.
The concept is actually pretty simple. They aren't programmed with code that says weld here. They are trained. They are trained to see and understand.
Okay, explain that distinction. Trained to see. That's a big leap.
It means they use cameras, basically like eyes, and a neural network, basically like a brain. If the car chassis moves 3 inches to the left, the robot sees that it moved and adjusts its arm to the new position, just like you or I would.
So it has an intuition about the physical world.
A learned intuition, yes. And once you have a general purpose laborer, a machine that can fold laundry, then weld a car, and then go make a coffee, you break the constraint of specialized machinery. You have a unit of labor that is suddenly fungible.
Fungible, meaning I can take the exact same robot off the assembly line and tell it to go work in the warehouse or go work in the mine without having to rebuild or reprogram the whole machine.
Precisely. And that fungibility leads directly to this concept of the recursion loop that text talks about. This is where things get really wild.
This is the robots building robots part.
Yes.
And this is the part of the analysis where the math gets dizzying.
It is, but you have to stick with it because this is the engine that creates the age of abundance.
Okay, walk me through it.
All right. Think about the cost of a car today. Why is it expensive?
Well, the materials, the steel, the plastic, the computer chips.
But why are those things expensive? Let's go deeper. The steel is expensive because paying the humans to mine the iron ore is expensive. Paying the humans to run the steel mill is expensive. Paying the humans to ship the steel on a truck or a train is expensive. Paying the humans to design the car and then assemble the parts is expensive.
It's wages all the way down.
It's wages all the way down. That's the perfect way to put it. But now, run the same scenario. A robot mines the ore.
And the robot just works for the cost of electricity.
Right. And another robot drives the truck, and a different robot assembles the car. What cost is left?
The raw materials from the earth. The energy.
Exactly. The only fundamental cost left is the raw energy from the sun, captured by solar panels, and the raw atoms from the earth. The source argues that the marginal cost of production, that's the cost to make one more car or phone or house, starts to approach zero.
It becomes like software.
Yes, that is the perfect analogy and the one the source uses as well. Think about Microsoft Word.
Okay.
It probably cost Microsoft maybe hundreds of millions of dollars to pay all the software engineers to write the first version of that code. That was the initial capital
It's a
expenditure.
huge upfront cost.
Huge. But how much does it cost them to sell you one more copy today?
Nothing. It's a download. It costs zero.
Exactly. The marginal cost is zero. That's why software companies are some of the most profitable businesses in the world. And what we're talking about here is a world where physical matter starts to behave like software.
Copy-pasting a house. Copy-pasting a car.
It's a jarring concept.
That sounds completely utopian, but my wallet is throbbing just thinking about the transition to get there. Because if the value of labor goes to zero, the economy isn't capital times labor anymore.
Right.
It's just capital.
Right. It's just E equals C.
And if you don't have any capital, which most people don't, you're in a lot of trouble.
If you rely on selling your labor to survive, which is what 99% of the population does, and the value of that labor hits zero, you have no income.
Yeah, that's the scary part. We're definitely going to get to the how to survive or even benefit from this in Section 5, because that's absolutely crucial for anyone listening, especially if you're managing a nest egg. But before we get there, we have to talk about the direct result of this zero-cost labor. Section 2. The source uses a word that usually makes economists, and frankly anyone with a mortgage, wake up in a cold sweat.
It does.
Deflation.
Yes, deflation. In all the financial news on every business channel, deflation is the boogeyman. It's the Great Depression. It's Japan's lost decade. It means prices are dropping, companies are failing, everyone's going broke.
So why is this source throwing a party for deflation? They don't just call it deflation, they call it hyperdeflation. Are they crazy?
Context is king here. This is probably the most important distinction to make in this entire deep dive. We have to distinguish between bad deflation and good deflation.
Okay, break that down for us. What's the difference?
Okay, bad deflation is a monetary collapse. It's what everyone fears. It's when there's a crisis, nobody has any money, so demand for goods craters. Businesses slash their prices out of pure desperation to get any cash flow.
But nobody buys anything anyway.
Right, because either they're broke or they think, well, if I wait a month, that TV will be even cheaper.
Wow.
So they wait. The business dies. It fires all its workers, who then have even less money to spend.
The death spiral.
A classic death spiral. That's the 1930s scenario. That's bad deflation.
Okay, so what on earth is good deflation?
Think about your living room wall. Think about your flat-screen TV.
I've got one.
20 years ago, a 60-inch plasma TV was a major status symbol. It was a luxury item for the rich. It cost, what, $15,000?
At least. And it weighed a ton.
Right. And today,
Wow.
you can walk into Walmart or Best Buy and get a better, lighter 4K 60-inch TV for $300.
Yeah, it's an impulse buy almost.
And you don't wait to buy it. Right. You don't say, oh, I'll wait till next year when it's $280. You just buy it because it's incredibly cheap and provides immense value.
Right.
That is technology-driven deflation. The manufacturing process got better, the supply chain got more efficient, the scale of production increased, and the price just collapsed.
And did Samsung go out of business because of that?
No, of course not. Did the global economy crash because TVs got cheap? No. We just entered an age of abundance for high-definition televisions. Now pretty much everyone has one.
So the source is arguing.
Right.
We're about to take that TV trend and apply it to everything.
To everything. Food, housing, healthcare, transportation. Think about it. The source suggests that if human labor accounts for anywhere from 50 to 80% of the final cost of these things.
Which it does once you factor in the whole supply chain.
Exactly. And you remove that labor cost from the equation, then the price curve of a new house should start to look a lot like the price curve of that flat-screen TV over the last 20 years.
That is a wild image to conjure. A luxury home in a nice neighborhood costing the same as a 2024 Honda Civic.
It breaks your brain a little bit, doesn't it?
It does.
Because we are so deeply conditioned to think that scarcity is the default state of the world.
Right. I have to work hard for 40 years to afford this one scarce thing, a house.
And this source is asking a fundamental question. What happens when the housing market starts to look like the software market? What happens when shelter is no longer scarce?
But here's the snag. I see a problem here. In the TV example, I still had a job that paid me the money to buy the $300 TV.
Ah, yes, the
If the
paradox.
robots take all the jobs to make the houses cheap, I don't even have the money to pay the ridiculously low price.
And that is the paradox. That is the crucial transition problem. And that's where this concept of universal high income that the source teases comes into play.
Okay.
It's not about giving everyone $1 million of inflated, worthless currency. It's about the cost of survival food, energy, housing, transport dropping so low that a very small amount of capital distribution from the productive robot economy makes you feel like a king.
Surprising richness. That was the exact phrase they used in the text.
Right. Think about it. If your mortgage or rent is $50 a month, your food bill is $20 a month, and your transportation is effectively free because of self-driving electric vehicles. You don't need a six-figure salary to live like a billionaire from the 20th century.
Because wealth isn't really the number in your bank account. It's your purchasing power.
It's always been purchasing power.
It reminds me of that old sci-fi trope, the post-scarcity society, Star Trek economics.
Yeah.
No money, they just have replicators that can make anything.
And look, we aren't getting magic replicators that turn air into a hot cup of Earl Grey tea. Let's be realistic.
Not yet, anyway.
Not yet. But we are getting the next best thing, supply chains that are so automated and so efficient that the end product is functionally free compared to today's wages.
But, and this is a massive, but we have to survive the middle part, the transition. You can't just teleport from today's economy to the Starship Enterprise.
No, you can't.
And the source has a very stark warning label in Section 3 that we need to unpack. Because getting from here to there usually involves a lot of chaos and pain.
They call it the period of confusion, the valley of death, between the two economic models.
Yeah, let's dig into that.
Yeah.
Because I can guarantee you the IRS is not ready for this.
Oh, they absolutely are not. Not even close. Think about the fundamental structure of the United States government, or any modern government, really. How is it funded?
Primarily income tax, payroll tax, corporate tax on profits.
And what do all of those have in common?
They're all taxes on labor in one form or another.
Exactly. Income tax is a tax on you selling your time. Payroll tax is a tax on a company for the privilege of hiring a human. Corporate taxes are based on profits generated by human and capital inputs.
So if this age of abundance arrives and humans largely stop working for income because the robots are doing it all, that tax base just evaporates almost overnight.
Poof. Gone. So the government potentially goes broke at the exact moment that people need a social safety net the most.
That's a recipe for disaster.
It's a huge problem. And the source explicitly states that the entire model for collecting taxes must change. You can't tax a wage that doesn't exist.
So what do you tax?
You have to tax the robots. Or you tax the production capacity of the factories. Or you move to a purely consumption-based tax. But think about the politics of that. Changing a tax code takes decades of brutal political fighting.
And this technology is moving in a 5 to 10 year window.
That's the friction. That's the danger. The technology moves at the speed of an exponential curve, and our government and social structures move at the speed of a sloth.
And in that gap, that's where you get social unrest.
You do. And it's not just about money. You have people losing their entire identity. For thousands of years, who you are has been fundamentally tied to what you do.
I'm a carpenter. I'm a doctor. I'm a truck driver.
Yes, it's the first question you ask someone at a party. So what do you do? If a machine suddenly does that thing better, faster, and cheaper than any human ever could, who are you?
That's a deep existential crisis for society to go through all at once.
It is. But let's stick to the practical crisis for a moment. The transition period. This is what I really want to clarify for our listeners, especially those who are maybe retired or nearing retirement.
Because they might be sitting there thinking, well, I don't work anymore, so this doesn't affect me. My job can't be taken.
But it absolutely does affect you, because your pension, your Social Security, your 401k, they are all deeply intertwined with the health of the old labor-based economy.
How so? Take Social Security.
Social Security is a direct transfer payment. It's funded by taxes on today's workers paying for today's retirees. It's not a savings account with your name on it.
So if there are no current workers, or far fewer of them,
The Ponzi scheme, to put it bluntly, stops. The mechanism breaks.
that's terrifying for millions of people.
It is. Now, the source is actually optimistic that the immense wealth generated by the new robot economy will eventually solve this. If the overall economic pie grows 100x because of robot labor, then the government can easily tax a tiny sliver of that to fund Social Security and more.
But the transition,
the transition, the months or years where the old jobs are gone, but the new tax system isn't fully in place and functioning. That is the danger zone. That is the valley of chaos.
So we have a really clear picture of the problem now. A massive, technology-driven deflationary boom that could be wonderful in the long run, but which breaks the labor market, the tax system, and even our sense of identity in the short run.
Pretty good summary.
Now let's look at the culprit, or the savior, depending on your point of view. Section 4, the technology driver, Tesla's Optimus.
Yes, the source is very specific here. It identifies Optimus as the catalyst. Not just a robot, but the robot that kicks us all off.
Okay, so why Tesla? I mean, I've seen the Boston Dynamics videos, everyone has. I've seen those dog-like robots and the parkour robots doing backflips. They look incredibly impressive.
They are impressive.
So why does this source think a car company is going to win this race?
It comes down to two things that Tesla has and Boston Dynamics doesn't. A path to mass manufacturing at scale and the brain.
Let's start with manufacturing.
Boston Dynamics makes incredible machines, but they're more like Formula One race cars. They're expensive, hydraulic, custom-built research projects. They cost tens, maybe hundreds of thousands of dollars each.
They're not making millions of them.
No, Tesla, on the other hand, is trying to build a robot the way they build a Model Y.
Mass production. Stamped metal.
Yeah.
Cheap, custom-designed parts.
Exactly. The source makes a point of mentioning the actuators. Those are basically the muscles of the robot. Tesla didn't buy them off the shelf. They designed their own, specifically to be mass manufactured cheaply and reliably. But the real key, the thing that separates them, is the brain, the AI.
We touched on this earlier with the seeing and understanding concept.
Right. It's what they call inference compute.
Mm.
Most old robots, and even some of the Boston Dynamics ones, run on complex lines of code that say, if sensor A detects a wall, stop. It's logic-based.
It's then statements.
A very, very long list of them. Tesla's approach, which they've developed for their cars, is end-to-end neural networks. They don't program the robot, they show it.
What do you mean they show it?
They feed the robot's neural network millions of hours of video of humans doing tasks. Folding laundry, using a power drill, inspecting a part. The robot just watches. It learns the patterns. It starts to develop an intuition for how the physical world works.
So it's pixels in, actions out.
That's the phrase they use, correct. The robot doesn't know what a coffee cup is in a mathematical sense. It just knows from watching a million videos that when it sees that particular collection of pixels, it should shape its hand a certain way to grab it without crushing it. This allows it to learn, theoretically, anything a human can do.
And the timeline for this is the part of the source that I got really stuck on. It mentions mass production of a third-generation bot starting this year.
It does. It mentions the preparation is already underway. And it breaks down the production numbers in a way that directly relates to what technologists call the S-curve.
Okay, walk us through the S-curve. This is a crucial concept for anyone trying to understand this, especially from an investment perspective.
So in technology adoption, things don't grow in a nice, neat, straight line. They grow in an S shape. They start very flat for a while.
That's the bottom of the S.
Right. That's the phase of prototypes, failures, slow, painful growth. The source predicts the first production run will be maybe hundreds of robots, then thousands, then maybe the first 1 million units.
And even 1 million humanoid robots. That still sounds like a lot. But in a global economy of 8 billion people, it's a drop in the bucket. It's a curiosity.
Exactly. That's the deceptively flat part of the curve where everyone says, see, I told you this was overhyped.
But then what happens?
But then you hit the knee of the curve, the steep vertical part of the S. This is where the source predicts an explosion in production, going from that first 1 million to 100 million units by the fourth generation of the robot.
100 million.
100 million humanoid robots.
That's a workforce larger than the entire population of Germany.
It's a workforce larger than many major countries combined. And remember, they don't sleep. They can work 24/7 without breaks, without vacation. So their actual output is equivalent to maybe 300 million human workers.
And the source compares this growth model directly to Tesla's FSD, their full self-driving software.
It does. It's the same pattern.
Explain that parallel.
Well, think about how FSD has been developing. For years, it was slow, it was glitchy, it required constant human intervention. People mocked it. Oh, it can't handle a roundabout. It freaked out at a plastic bag.
It was on the flat part of the S-curve.
Precisely. But all that time, the AI was learning from every single mile driven by every single Tesla on the road. It was collecting data.
And this is what they call the data flywheel.
The data flywheel, exactly. The more robots you have out there in the world, the more data they collect on how to perform tasks. The more data they collect, the smarter the central AI brain gets. The smarter the brain gets, the more useful and capable the robot is.
And the more useful it is, the more you sell, which gets you more data.
And the loop spins faster and faster. And then you just copy-paste that incredibly smart, updated brain into 100 million new robot bodies.
So the hardware is just the show. The real value is the synergy between the AI software and the mass-manufactured hardware.
That's the core of it.
Yeah.
And the source is incredibly adamant about the timeline. This is not 50 years away. I want to read the quote directly. It says, quote, "This change will inevitably happen within 5 to 10 years."
That is a very specific and a very aggressive window, 5 to 10 years. If you are 65 years old today, this happens while you are in your early 70s.
This isn't for your grandkids' future. This is for your future.
It's for right now. Which brings us to the so what for the listener. If you're sitting there, maybe driving your car, listening to this and thinking, okay, great, robots are taking over, money's about to get weird, what on earth am I supposed to do?
The source has a very, very specific answer in Section 5.
The investment insight. And this is where we really want to focus for a bit, especially for our listeners who might be in or near retirement. You've spent a lifetime accumulating assets. You have a house, maybe some stocks, some bonds. The goal has always been preservation of capital.
Right. Don't lose what you have.
But this source is suggesting that the traditional safe play might actually be the most dangerous one now.
It's a complete inversion of traditional financial advice. The source's core thesis is simple, and they state it very clearly. To enjoy this change rather than suffer from it, you must own the means of production.
Own the means of production. That phrase has a lot of historical baggage. It sounds a little Marxist. But here it means something very different, something very capitalist.
It does. In the old economy, the one we're still in, you owned your labor. That was your primary asset. You sold your time for money. Or you owned debt, things like bonds, which paid you interest based on the stability of the currency in the old economy. In the new economy, if your labor is suddenly worth zero and the cost of goods collapses, which crushes the value of currency, you need to own the thing that is creating all the value. You need to own the robots.
But I can't just go out and buy an Optimus robot and, send it to work at the local Starbucks to earn money for me. Not yet, anyway.
No, not as an individual, but you can own the company that makes them. And the source's specific, actionable advice is to buy Tesla stock.
Now, hold on a minute, because I know what some listeners are thinking. Tesla is a volatile stock. It goes up, it goes down 20% in a month sometimes. It's scary for a conservative investor who's been told to buy index funds and bonds.
It is.
So why does the source frame this as a safety play? That seems counterintuitive.
You have to think about the risk differently. If the source is right and we are about to enter an age of hyperdeflation, what happens to other companies?
I get crushed.
Companies that rely on traditional labor and pricing power are going to get absolutely crushed. What happens to real estate values if the cost of building a new house drops by 90%?
The value of existing homes would plummet.
What happens to the value of a 30-year government bond if interest rates collapse because there's no inflation? The entire safe, diversified portfolio that financial advisors have recommended for 50 years is a bet on the status quo.
And if the status quo is about to be shattered, the portfolio gets shattered with it.
Exactly. The source argues that in this specific transitional moment in history, owning the primary driver of the disruption is the only true hedge. It's the only safe harbor.
Because if Tesla succeeds in building, say, 10 billion robots over the next couple of decades, it becomes the most valuable company in human history by a factor of 10 or 20.
And owning even a tiny piece of that economic engine effectively offsets the chaos and devaluation happening in the rest of your old economy assets.
So it's not a speculative bet. It's insurance.
It is insurance against the age of abundance. A very strange concept, but that's what it is.
And what about the method? The source isn't telling people to, take out a second mortgage and dump their life savings into the stock all at once, right? Because that's how you lose your shirt in a volatile market.
No, absolutely not. And this is where the advice actually aligns with a more conservative long-term mindset that many of our listeners would be familiar with. The source advises to accumulate monthly.
Just buying consistently.
Just buying consistently, even if it's just one share at a time. This is the classic time-tested strategy of dollar-cost averaging.
Which takes the emotion out of it. You don't try to time the market. You don't panic and sell if it's down 5% this week, and you don't get greedy if it's up.
You are just methodically, patiently accumulating shares of the future production capacity of the planet. The core idea is that right now, today, the market is pricing Tesla primarily as a car company.
It looks at how many cars they sell each quarter.
Right. It's linear thinking. But the source is arguing that in 5 years, the market will re-rate it as the world's primary labor company.
And the stock market is notoriously bad at pricing things that haven't happened yet. It's reactive.
The market is terrible at pricing exponential growth. It thinks, okay, they sold 10% more cars this year, so the stock is worth 10% more. It doesn't have a model to price the sentence. In 5 years, they will begin to replace the entire global labor force.
It can't compute that.
Not until it's obvious.
Which is why the source argues there is an urgency to start now,
Okay.
before that S-curve we talked about goes vertical.
Before the explosion in value occurs, if you wait until there are 100 million Optimus robots walking around, well, everyone will know the story then.
Right.
The stock price will already reflect that new reality. It will be too expensive for the average person to get in for the massive gains.
You have to buy the rumor to sell the news. Or in this case, buy the rumor to own the new economy.
That's the idea.
Just so interesting. Usually when we talk to seniors or people planning for their legacy, the advice is always diversify, be safe, avoid volatility at all costs.
Mm-hmm.
But this source is turning that completely on its head. It's saying that in a moment of technological singularity or something approaching it, safety is actually exposure.
Exposure to the upside, yes. Because if the cost of living really does plummet to near zero, you don't actually need millions of dollars in a bank account to survive and live well, but you do need a stake in the new system. You need to be a shareholder of the abundance, not just a bystander watching it happen.
And it's a 5 to 10 year window. That's the critical period they keep coming back to.
It is. It's short enough that you can see it on the horizon, but it's long enough that you still have time to take action. If you start accumulating a position now, that position can grow as the technology matures and the world wakes up to what's happening.
So let's try and wrap this all up. It's a huge topic. We've gone from a simple math formula economy equals capital times labor all the way to a sci-fi future with 100 million robots.
And landed on a very practical investment strategy of monthly accumulation.
It's a lot to digest.
It is. But I think the chain of logic holds together, whether you agree with the conclusion or not. If robots can build other robots, then labor costs crash. If labor costs crash, the price of physical goods crashes. If goods are incredibly cheap, we enter an age of abundance.
But to survive the chaotic transition, to bridge that gap where the old world dies and the new one is born, you need to own a piece of the system that's creating that abundance.
That's the thesis in a nutshell.
And for you, the listener, especially the listener who is looking at their portfolio and thinking about their kids and grandkids, this isn't framed as gambling. It's framed as understanding a massive macroeconomic trend.
You wouldn't have bet against the rise of the internet in 1995. The argument is you shouldn't bet against the rise of general-purpose robotics in 2025.
The world is about to get very weird and potentially very, very wonderful, but only if you're positioned correctly for it. And I want to leave you, our listener, with a final thought. It's something that wasn't explicitly spelled out in the investment text, but it feels like the shadow hanging over this entire conversation. We talked about the money, we talked about the stocks, the economics, but the source keeps coming back to this idea that the cost of living will plummet and the need for jobs will all but disappear.
Which brings us right back to the philosophical question we touched on earlier.
Exactly. If the definition of labor as we know it disappears, and you don't have to work to eat or to house yourself, how does that change your definition of a meaningful life?
It's a profound question.
If you're retired, you might already be grappling with a version of this. What is my purpose now that I'm not earning a living?
This is that question, but for all of society. We are all about to be retired, in a sense.
Humanity is retiring. If the fundamental struggle for survival is just solved by machines, is your financial portfolio the only thing that needs to be restructured? Or is it your very identity? What do you do on a Tuesday morning when the world is effectively free?
That is something a robot can't answer for you. And honestly, it's a much harder problem to solve than the engineering one.
It is. Something to think about tonight while you're watching the news. Or maybe while you're looking at that Tesla chart. Thanks for diving deep with us. We'll see you in the future.
Goodbye, everyone.